Hello, my dear students. A very warm welcome to all of you in Shri Jayendra Rank Zone. I am your friend and mentor for the subject Principles and Practices of Accounting. In this lecture, we'll begin with Accounting Chapter 8, Unit 4, that is Retirement of a Partner. Let us begin. We are continuing with partnership accounts, and in particular we'll begin with Unit 3, Retirement of a Partner. Let us quickly begin with the learning objectives. Learning outcomes. After studying this unit, you will be able to learn how to compute the gaining ratio and observe the use of such gaining ratio. Be familiar with the accounting treatment in relation to revaluation of assets and liabilities. Revaluation of assets and liabilities. Learn the accounting entries to be passed for transfer of reserves standing in the balance sheet to partner's capital account in a manner already discussed for admission of a partner in Unit 3 of this chapter. Learn the technique of keeping records if the balance due to the retiring partner is transferred to loan account. Familiarize with the JLP, that is Joint Life Policy. Learn how to keep records for payments of premium in relation to joint life policy. Also observe the accounting treatment in relation to such joint life policy in case of retirement of a partner. Overview of the unit. Revaluation account, profit and loss adjustment account for evaluation of assets and liabilities. We have already learned in admission of a partner, that was Unit 3. Adjustment of goodwill amongst the remaining partners in their profit gaining ratio. Transfer of reserves, goodwill, transfer of profit or loss on revaluation to retiring partners. Profit or loss on revaluation account is transferred to all partners in their all profit sharing ratio. Introduction. A partner may retire from the partnership firm because of the old age, illness, etc. Generally, the business of the partnership firm may not come to an end when one of the partner retires. Other partners may constitute to run the business of the firm. Readjustment takes place in case of retirement of a partner, likewise in case of admission of a partner. Whenever a partner retires, the continuing partner makes gain in terms of profit sharing ratio. Therefore, the remaining partners arrange for amount to be paid to discharge the claims of retiring partners. Assets and liabilities are revalued, goodwill is raised, and surrender value of joint life policy, if any, is taken into account. Revaluation, profit, and reserves are transferred to capital and current accounts of partner. Lastly, final amount due to the retiring partner is determined and discharged. Calculation of gaining ratio. On retirement of a partner, the continuing partner will gain in terms of profit sharing ratio. For example, A, B, and C are sharing profits and losses in the ratio of 5:3:2, and B retires. Then A and C, the remaining partner, have to decide at which ratio they will share the profits and losses in future. If it is decided that the continuing partners will share profits and losses in future in 3:2 ratio, then A gains 1 by 10th, that is 3/5 minus 5 by 10, and C gained 2 by 10, that is 2 by 5 minus 2 by 10. So the gaining ratio between A and C is 1:2. If A and C decide to continue at the ratio of 5:2, This indicates that they are dividing the gained share in the previous profit sharing ratio only. Example: Amir and Jamir and Samir. Amir, Jamir, and Samir are in partnership, sharing profits and losses in the ratio of 3 is to 2 is to 1. Now, Amir wants to retire and Jamir and Samir wants to continue in the ratio of 3 is to 2. In this case, Jamir gains 830 of share of partnership, 3 by 5 less 2 by 6, whereas Samir gains 7 by 38 share, that is 2 by 5 minus 1 by 6 share of the partnership. So, gaining ratio between Jamir and Samir is 8 is to 7. On the other hand, if Jamir and Samir would decide to continue sharing profits and losses in the ratio of 2 is to 1, then Jamir would gain 2/6 share in the partnership. That is 2 by 6, 2 by 3 minus 1, 2 by 3 minus 2 by 6. And Samir would gain 1/6 share in the partnership. That is 1 by 3 minus 1 by 6. So it appears that in such a case, gaining ratio of Jamir and Samir would be 2 is to 1. That is, gaining profit sharing ratio between them. Thus, on the retirement or death of a partner, his share of profit would be taken by the remaining partners. In other words, they get additional share, which is obviously a gain or a benefit. The remaining partners will get additional share, that is a gain or it is a benefit. The calculation of gaining ratio or benefit ratio is done as follows. First, when the new ratio is given, gaining ratio is calculated by deducting their new share of profits from the old share. When the new profit sharing ratio is not given, the remaining partners share the future profits in the same ratio as before, and the gaining ratio would be the old profit sharing ratio. Observe this table. Ratio between remaining partners. New ratio, gaining or benefit ratio. First, when new ratio is already given, new ratio will be as given in the examination problem. Gaining or benefit ratio is the new ratio minus old ratio. Second case, when the new ratio is not given, the new ratio will be the same old ratios between the partners. What is the gaining ratio? The same old ratios between the partners. Case 3, when gaining or benefit ratio is given in the question, old ratio plus gaining ratio will be the new ratio and gaining ratio will be as given in the question. I believe you understood. Let us move ahead. Calculation of new profit sharing ratio. Case 1. When nothing is given about the new profit sharing ratio and the remaining partners, under this situation, the calculation of new ratio is done by striking out the share of retiring partner. Example: Alok, Bhaskar, and Chetan are partners sharing. The profit sharing ratio is 3 is to 2 is to 1. Calculate new ratio if A. If Alok retires, B. If Bhaskar retires, and C. If Chetan retires. The old profit ratio is given 3 is to 2 is to 1. If Alok retires, the new profit sharing ratio will be 2 is to 1 between the Bhaskar and Chetan. Bhaskar and Chetan. If Bhaskar retires, the new profit ratio is 3 is to 1 between Alok and Chetan. If Chetan retires, the new profit sharing ratio between Alok and Bhaskar. Alok and Bhaskar. I believe you understood. Case 2. When Gains of continuing partner are especially given in the question. The gain is already given in the question. In such a case, the new shares of the continuing partner is calculated by adding their respective gain to the old share. New share equals old share plus gain equal to new share. Example: Arav, Banta and Chunmun are partners sharing profits in the ratio of 3 is to 2 is to 1. Arav retires and its share is taken over by the remaining two partners as follows. Banta takes 2 by 6th share from Arav and Chunmun takes 1 by 6th share from Arav. Calculate new ratio. Banta's new share will be Banta's old share plus Banta's gain. Banta's old share is 3 by 6. Banta's old share is 2 by 6. So 2 by 6 plus Banta's gain from Arav is 2 by 6. So 2 by 6 plus 2 by 6 equals 4 by 6. Chunmun's new share is Chunmun old share plus Chunmun's gain. Chunmun's old share is 1 by 6 plus Chunmun takes 1 by 6 from Arav. So 1 by 6 plus 1 by 6 is 2 by 6. So the new share is 4 by 6 and 2 by 6, that is 2 is to 1. I believe you understood. Case 3. When the ratio in which the remaining partners acquire the share of outgoing partner is given in the question specifically. Deepu, Tasha and Honey are partners sharing profits and losses in the ratio of 3 is to 2 is to 1. Tasha retires and his share was acquired by Deepu and Honey in the ratio of 2 is to 1. Calculate new ratio. Share acquired by Deepu 2 by 6 multiplied by 2 by 3, that is 2 is to 1. So in the ratio of 2 is to 1. So 2 by 3 equals 4 by 18. Share acquired by Honey, that is 2 by 6 multiplied by 1 by 3, that is 2 by 18. Deepu's new share will be Deepa's old share plus Deepu's new share. Deepa's old share is 3 by 6 plus Deepa's gain is 4 by 18. New share is 13 by 18. Honey's new share will be Honey's old share plus Honey's gain. Old share is 1 by 6 and gain is 2 by 18. So new share is 5 by 18. The new share is 13 is to 5. I believe you understood. Let's learn how to calculate gaining ratio. Calculation of gaining ratio. Case 1. A, B, C are partners sharing profits and losses in the ratio of 1 by 2, 3 by 10 and 1 by 5 respectively. B retires from the firm and A and C decide to share future profits and losses in the ratio of 3 is to 2. Their new share is 3 by 5 and 2 by 5. 3 is to 2, so 3 by 5 and 2 by 5. Their old share is 1 by 2 and C's case 1 by 5. Difference being the gain. So old share is 3 by 5, new share is 1 by 2. So gain is 1 by 10. In case of C, the gain is 2 by 10. So gaining ratio between A and C is 1 by 10 and 2 by 10. That is 1 is to 2. Case 2. W, A, B, C are partners sharing profits and losses in the ratio of 1 by 3, 1 by 6, 1 by 3 and 1 by 6 respectively. B retires and WAC decides to share profits and losses equally. B retires, B's share is 1 by 3. B retires and WAC decides to share futures profits equally. That is 1 is to 1 is to 1. Their new share is 1 by 3, 1 by 3, 1 by 3. Old share is 1 by 3, 1 by 6 and 1 by 6. Difference between the old share and new share is the gain. So in case of A, there is no profit, no loss. In case of B, it is gain 1 by 6 and C 1 by 6. Gaining ratio between A and C is 1 is to 1. Gaining ratio between A and C is 1 is to 1. Case 3. A, B and C are partners sharing profits and losses in the ratio of 25 is to 15 is to 9. B retires and it is decided that profit sharing ratio between A and C will be the same as existing between B and C. Ratio of B and C is 15 is to 9 equals 5 is to 3. Therefore, new ratio of A and C should be 5 is to 3. Their new share is 5 is to 3, so 5 by 8 and 3 by 8. Their old share is 25 is to 49 and 9 by 49. 25 by 49 and 9 by 49 in case of A and C. Difference being the gain. That is 45 is upon 392 and 75 upon 392. The gaining ratio is 45 is to 79, that is 3 is to 5. I believe it is clear. Case 4. A, B and C are partners sharing profits and losses in the ratio of 4 by 9, 1 by 3 and 2 by 9. B retires and surrenders 1/9 of his share in favor of A and the remaining in favor of C. Their new share is A 4 by 9, C 2 by 9. Share surrendered by B because B retires. So 1 by 9 multiplied by 1 by 3 equals 1 by 27 and 8 by 9 multiplied by 1 by 3 equals 8 by 27. The new share of remaining partners is 13 upon 27 and 14 upon 27. The new ratio is 13 is to 14 and the gaining ratio is 1 is to 8. 1 is to 8. Case 5. Case 5. A, B and C are partners sharing profits and losses in the ratio of 1 by 2, 3 by 10 and 1 by 5. B retires. B retires and his share is taken over by A and C in the ratio of 2 is to 1. His share is 3 by 10. Then immediately W was admitted for 1/4 share of profit, half of which was gifted by A and the remaining share was taken by W equally from A and C. The existing share of A and C is 1 by 2 and 1 by 5. Share acquired by remaining partners, that is 2 by 3 of 3 by 10, that is 2 by 10, and 1 by 3 of 3 by 10, that is 1 by 10. New shares of remaining partner is 1 by 2 plus 2 by 10, that is 7 by 10. 1 by 5 plus 1 by 10 is 3 by 10. Share gifted by A. A share, that is 1 by 2 multiplied by 1 by 4, that is 1 by 8. Share acquired by W. 1 by 2 into 1 by 8 equals 1 by 16 and 1 by 2 into 1 by 8 is 1 by 16. New share, that is 41 upon 80 and 19 upon 80. The new profit sharing ratio between A, C and W is 41 upon 80, 19 upon 80 and 20 upon 80. 41 is to 19 is to 20. Revaluation of assets and liabilities on retirement of a partner. On retirement of a partner, it is acquired to revalue assets and liabilities, just as in the case of admission of a partner. If there is revaluation profit, then such profit should be distributed amongst the existing and including the retiring partner at the existing profit sharing ratio, that is the old profit sharing ratio. On the other hand, if there is loss on the revaluation, that is also to be distributed to all the partners including the retiring partner at the existing profit sharing ratio. To arrive at profit or loss on revaluation of assets and liabilities, a revaluation account and profit and loss adjustment account is opened. Revaluation account or profit and loss adjustment account is closed automatically by transfer to profit and loss by transfer of profit and loss balance to partners capital account. If it is decided that revalued figure of assets and liabilities will not appear in the balance sheet of the continuing partner, then journal entry should be passed with the amount payable or chargeable to the retiring partner, with the continuing partner will share at the ratio of gain. In the first instance, the journal entry for distribution of profit and loss on revaluation, which will appear in the balance sheet also, is as follows. Revaluation account debit to partners capital account for profit on revaluation, or partners capital accounts to revaluation account for loss on revaluation. Now see how to deal with a situation where revalued figure will not appear in the balance sheet. If A, B and C share profits and losses equally, and there is a revaluation profit of 30,000 calculated on A's retirement, then 10,000 becomes due to A, which is borne by B and C equally. So the journal entry will be as follows. B's capital account debit 5,000, C's capital account debit 5,000 to A's capital account 10,000. Alternatively, it is possible to account for the increase in the value of assets or decrease in the value of liabilities by debiting the appropriate assets account or liability account and crediting partners capital account at the existing profit sharing ratio. Simultaneously, the partners capital account are to be debited for such gain at the new profit sharing ratio, and respective assets and liabilities account is to be credited again, so that the following journal entries are necessary for 10,000 increase in sundry fixed assets and 2,000 decrease in trade payables. Sundry fixed assets account debit 10,000, trade payables account debit 2,000, to A's capital account 4,000, to B's capital account 4,000, to C's capital account 4,000. Distribution of revaluation profit amongst the existing partner in their old profit sharing ratio. B's capital account debit 6,000, C's capital account debit 6,000, to sundry fixed assets account credit 10,000, to trade payables account credit 2,000, being the revalued assets and liabilities are not required to be shown in the balance sheet. In this case, it is not necessary to open a separate revaluation account. However, the above effect can also be given through memorandum revaluation account as discussed in the case of admission of a partner unit 3. Reserve. What is a reserve? On retirement of a partner, any undistributed profit or reserve standing at the balance sheet is to be credited to the partner's capital account in the old profit sharing ratio. Alternatively, only the retiring partner's share may be transferred to capital account if the others continue at the same profit sharing ratio? For example, A, B, and C were in partnership sharing profits and losses in the ratio of 5 is to 3 is to 2. A retired and B and C agreed to share profits and losses in the ratio of 3 is to 2. Reserve balance was 10,000. In this case, either of the following journal entry can be passed. First, reserve account debit 10,000 to A's capital account 5,000, to B's capital account 3,000, to C's capital account 2,000. Transfer of reserve to partner's capital account in 5 is to 3 is to 2 on A's retirement, that is old ratio. Next, reserve account debit 5,000 to A's capital account 5,000. Transfer of A's share of reserve to capital account on his retirement. Note that alternative 2 has the same implication because B and C continued at the same ratio, that is 3 is to 2, as they did before A's retirement. Take another example where A, X, Y, and Z were equal partners. They decide to retire, Z decide to retire. X and Y decide to continue at the same ratio, that is 3 is to 2. X and Y decided to continue at the ratio of 3 is to 2, that is a new ratio. Reserve standing at the date when Z retire was 9,000. In this case, adjustment of Z share was not sufficient since the relationship between X and Y was also changed. We need to calculate gain of X and gain of Y. So the new share of X is 3 by 5 and the old share is 1 by 3. So gain is 4 by 15. Y's gain is 2 by 5 old share minus 1 by 3. 2 by 5 new share minus 1 by 3 old share. Gain is 1 by 15. Gaining ratio between X and Y is 4 is to 1. This is different from 1 is to 1. So alternative 1 is to be followed in this case. Reserve account debit 9,000 to X capital account, to Y capital account, to Z capital account in old profit sharing ratio, that is equal ratio. If the continuing partner wants to show reserve in the balance sheet, the journal entry will be X capital account will be debited, Y's capital account will be debited to Z capital account, that is 3,000. X and Y in the ratio of 4 is to 1, that is gaining ratio. So gaining partner's capital account debited to sacrificing partner's capital account. So the remaining partner is gaining partners and the leaving partner is sacrificing partner. The retiring partner is sacrificing partner. Final payment to a retiring partner. The following adjustment are necessary in the capital accounts. First is transfer of reserve, next is transfer of goodwill, and then transfer of profit and loss on revaluation reserve, on revaluation. After adjustment of above mentioned item, the capital account balance standing to the credit of retiring partner represent the amount to be paid to him. The continuing partner may discharge the whole claim at the time of retirement. Then the journal entry will appear as follows. Retiring partner's capital account debited to bank's account. Sometimes the retiring partner agrees to retain some portion of his claim in the partnership as loan. The journal entry will be as follows. Retiring partner's capital account debited to retiring partner's loan account to bank account. Because the retiring partner has retained some portion of his claim as loan. As a rule, The payment is made according to the terms of partnership agreement, which might provide one of the following alternatives. A. Repayment may be made in installments over a period of time and the interest is paid on outstanding balance, which will be treated as loan of the outgoing partner. The amount due may be treated as loan to the firm and return the firm will be either pay interest at a fixed rate or share of profits of the firm. Third, an annuity may be paid to the retired partner for life for an agreed number of years for the lifespan of some dependent. Out of the given three alternatives, any one alternative is to be followed. Illustration 1. Illustration 1. A and B are partners in the business sharing profits and losses in the ratio as A 3/5 and B 2/5. Their balance sheet as on 1st January 2015 is as follows. Asset side, plant and machinery, inventories, trade receivables, balance at bank, cash in hand. In liability side, we have capital account of A and capital account of B, reserve account and trade payables. B retires from the business owing to illness and A takes it over. The following revaluation was made. The goodwill of the firm is valued at 25,000. Depreciate plant and machinery by 7.5% and inventories by 15%. Doubtful debts provision is raised against trade receivable at 5% and discount reserve against trade payables is 2%. Required, journalize the above transactions in the books of the firm and close the partner's account as on 1st January 2015. Give also the opening balance sheet of A. Solution. Solution. We need to pass journal entries. Journal entries. Draw the format. Date. Particulars, debit, credit. Date. Particulars, debit, credit. The goodwill of the firm is valued at 25,000. On B's retirement, we need to adjust goodwill. So this goodwill is 25,000 and B's share in the firm was 2 by 5. So 25,000 multiplied by 2 by 5. 25,000 multiplied by 2 by 5 equals the goodwill of the firm is valued at 25,000 and B share is 2 by 5. So 25,000 multiplied by 2 by 5 is 10,000. First journal entry on January 1st. Next, we need to prepare reserve at the rate 2% on trade payable. So 7,500 multiplied by 2% reserve, that is 150. So reserve for discount on trade payables account debit 150 to profit and loss adjustment account 150. I believe you understood. Calculate profit or loss on profit and loss adjustment account 4,650 and it is 150. So it is a loss of 4,500 which is to be borne by the old partners. So A capital account debit, B capital account debit to profit and loss adjustment account, profit and loss adjustment account 4650 minus 150, it is 4500. This needs to be shared in the ratio of 3 by 3 is to 2. So 2700 1800. 2700, 1800 and 4500. Calculate B's share, B's final share. 15,000, that was B's capital 15,000. Credit 10,000, so plus 15 plus 10 25,000 plus 6 31,000 minus 1800 29,200. So B's capital account debit 29,200 to B's loan account 29,200 being transfer of B's capital account to his loan account. I believe you understood. Let us make the balance sheet now. Let us drop the balance sheet. Balance sheet. Assets, liabilities. Plant and machinery 18,500. Inventories 13,600. Trade receivable 15,000. less provision for doubtful debts, 750, less, so 14,250, bank balance 6,000, cash balance 500. A's capital account, B's loan account, B's loan account 29,200, trade payable 7,500, less reserve 2%, minus 150, 7,350. A's capital is 16,300. Balance sheet totaled at 52,850. 52,850. Let us move ahead. Let us move ahead. Illustration 2. X, Y, and Z were partners sharing profits as 3 is to 2 is to 1. Their balance sheet on 31st March stood as follows. Asset side, machinery 17,500, building 22,500, motor van 4,000, stock 12,500, debtors 8,000, less provision 250, 7750 outer column, cash at bank 1250, liability side capital X, Y, Z. X capital 20,000, Y capital 15,000, Z capital 12,500. Total 47,500. reserve fund, reserve fund 6,000, creditors 9,500, bills payable 2,500. Balance sheet totaled at 65,500. Balance sheet totaled at 65,500. Y retired on that date subject to the following conditions. First, goodwill of the firm be valued at rupee 9,000 and Y share of the goodwill adjusted in the accounts of X and Z. Second, machinery to be depreciated by 10% and motor van and motor vans by 15%. Motor vans by 15%. Next, third, stock to be appreciated by 20% and building by 10%. Building by 10%. Next, provision for doubtful debts. Provision for doubtful debts be increased by rupee 975. Next condition, provision for workmen's compensation to the extent of rupee 825 to be created. It was agreed that X and Z will share profits in the ratio of 3:2 in future respectively. Prepare revaluation account capital accounts of partners, capital accounts of the partners, and the balance sheet, and the balance sheet of the firm after retirement of Y. After retirement of Y. Let us solve it. Solution. Solution. Revaluation account. Revaluation account. Particulars. Amount. Particulars. Amount. Machinery is depreciated by 10% and motor van by 15%. To machinery. To machinery account 1750. To motor van account 600. Stock is to be appreciated by 20% and building is to be appreciated by 10%. By stock 2500. By buildings 2250. Provision for doubtful debts is increased by 975. To bad debts, to bad debt 975, or to provision for doubtful debts 975. Provision for workmen compensation fund to the extent 825 is created. To provision for workmen compensation fund 825. Calculate profits 4750. 4750. 600 balancing figure. To profit transferred to X capital account, Y capital account, Z capital account. In old profit sharing ratio, that is 3 is to 2 is to 1, 300, 200, 100. I believe it is clear. Let us prepare partners capital account now. Partners capital account. Partners capital account. A, B, X, Y, Z, X, Y, Z. By balance brought down, by balance brought down 20,000, 15,000, 12,500. Sharing of revaluation profit by revaluation profit 300, 200, 100. Y share of goodwill is 9,000 multiplied by 2 by 6, that is 3,000. This is to be distributed between X and Z. This is to be distributed between X and Z. Goodwill. Y share of goodwill 9,000 multiplied by 2 by 6, 3,000. This 3,000 should be distributed in the gaining ratio. So X, Y, and Z. Old ratio minus new ratio. Old ratio is 3 by 6, 2 by 6, 1 by 6. New ratio is 3 is to 2, so 3 by 5 and 2 by 5. It is multiplied by 5 multiplied by 6 by 6. 15 upon 30 minus 12 upon 30, that is minus 3 upon 30. It is gain Z. 5 by 5 multiplied by 5 by 5. 5 upon 30 minus 12 upon 30 equals to minus 7 upon 30. So it is gain. This means X and Z, the gaining ratio is 3 is to 7. So goodwill, that is 3,000, is distributed in this ratio 900, Z 3,000, 7 by 10, 2,100. I believe you understood. By X capital account 900, by Z capital account 2,100 to Y capital account. In X it is 900, in Z it is 2,100. Distribution of reserve fund by reserve fund 3,000, 2,000 and 1,000 in the old profit sharing ratio. Let us close it. 13,600, 20,200, for X 23,300. 23,300, 20,200 and 13,600. 13,600 minus 2,100 is 11,500. In Y it is 20,200, that is Y's loan. So to Y's loan balancing figure, and for X it is 22,400 to balance carried down. To balance carried down. I believe you understood the partner's capital account. Let us prepare the balance sheet now. Write a note over here. Since question is silent about payment to Y, the amount due, the amount due to him is transferred to his loan account. His loan account. Balance sheet. Prepare balance sheet. Balance sheet of X and Z as on 31st March. As on 31st March. Liabilities, amount, assets, amount. In assets, write machinery 15,750, then buildings 24,750, motor van 3,400, stock 15,000, debtor 8,000 less provision 1225, that is 6775, and cash at bank 1250. Liability side, capital X and Z 22,400, 11,500, 33,900, then Y's loan 20,200, provision for workmen compensation 825, creditors 9,500, and bills payable 2,500. Balance sheet totaled at 66,925. 66,925. I believe you understood. I believe you understood this. We are keeping it till here. We are stopping here. We are stopping here. Thank you.